Hey everyone, welcome to another deep dive, this time on retirement plans in the US.
It's a jungle out there.
It really is, so we're going to try to clear some of that up using some great source material. I think by the end of this, you'll feel a lot more confident.
Absolutely.
Now, full disclaimer, we're not giving financial advice, we're just breaking things down.
That's right.
So let's kick off with pre-tax plans. These are also called tax-deferred. What's the basic idea here?
Well, it's pretty straightforward. You're basically contributing money now.
Before taxes.
Exactly. Before taxes are taken out, and then you pay taxes on that money later when you withdraw it in retirement.
Okay, so it's like kind of like delaying when you pay those taxes.
Exactly. And the idea is that by doing so, you might be able to lower your overall tax burden.
Lower your tax burden, always a good thing. Can you give me an example of how that works?
Yeah. So let's say you're currently in a high tax bracket, but you expect to be in a lower tax bracket when you retire. By contributing to a pre-tax retirement plan, you're pushing those tax payments to when you're in a lower bracket.
Precisely.
That makes sense. So it's all about strategically managing those taxes. Okay, so we've got this concept of pre-tax contributions. What are some of the plans that fall under this umbrella?
So one of the most common ones you'll hear about is the 401k.
Right, the 401k. It's often offered through employers, right?
Exactly. And it allows you to contribute a portion of your paycheck.
Before those taxes are taken out.
That's right.
And what's the contribution limit for 2024?
So for 2024, you can contribute up to $23,000.
Okay, so that's a pretty decent chunk of change.
It is. And if you're 50 or older,
There's a catch-up contribution, right?
right, you can contribute an additional $7,500.
So essentially you can shelter even more money from taxes.
Exactly.
Got it. Okay, so that's the 401k in a nutshell. What about folks who aren't employed by a company that offers a 401k? What are their options?
Well, there's the traditional IRA individual retirement account. And as the name suggests, it's designed for individuals. Anyone can contribute to a traditional IRA regardless of their employment status.
So even if you're self-employed, you can still take advantage of this tax-deferred growth.
Exactly.
And what's the contribution limit for a traditional IRA?
Lower than the 401k, it's $7,000 for 2024.
Okay. And is there a catch-up contribution for that as well?
There is. If you're 50 or older, you can add an extra $1,000.
Got it. So that's $7,000 or $8,000 if you're 50 or older. Okay. So far, we've talked about the 401k and the traditional IRA. Are there any other pre-tax options we should be aware of?
Yeah, for those who are self-employed or own small businesses, there's the SEP IRA.
SEP IRA, what does SEP stand for?
It stands for Simplified Employee Pension.
Simplified Employee Pension. Okay, so is this only for people who have employees?
Well, it can be used by small business owners or self-employed individuals, even if they don't have any employees.
Got it. So even if it's just you running the show, you can still utilize a SEP IRA. What's the main advantage of this type of plan?
One of the big advantages is the contribution limits. They're much higher than traditional IRAs or 401k. You can contribute up to 25% of your net self-employment income, up to $69,000 for 2024.
69,000, that's a lot more than the other plans we've discussed.
It is, but of course you'll want to make sure it aligns with your overall financial plan.
Right, because just because you can contribute that much doesn't mean you necessarily should. It's all about finding that sweet spot based on your individual circumstances.
Exactly.
Okay, so we've got a pretty good handle on some of these pre-tax plan options. Before we move on, are there any common misconceptions about pre-tax plans that you often come across?
You know, one thing I hear a lot is people thinking, oh, I'm never going to pay taxes on this money because it's pre-tax.
Right.
But that's not quite how it works.
You're still paying taxes, you're just kicking the can down the road a little bit.
Exactly. You're just deferring those taxes to a later date.
Okay, so it's super important to understand the nuances of these plans before jumping in. All right, we've covered a lot of ground with pre-tax plans. Ready to dive into the world of post-tax options.
Let's do it.
All right, so we spent a good amount of time on those pre-tax plans. Now let's flip the script and talk about post-tax retirement plans.
Sounds good.
So with post-tax, it's basically pay now, freedom later.
That's the gist of it, yeah. You contribute money that's already been taxed.
Okay.
And then when you withdraw it in retirement, those withdrawals are tax-free.
So let me make sure I understand this. I pay taxes on the money now, so I don't have to pay taxes later when I actually use it in retirement.
You got it.
Interesting. So
Right.
what's the thinking there? Why would someone choose to pay taxes up front?
Well, think about it like this. Let's say you're buying concert tickets.
Okay.
You could buy them now at face value, or you could wait and try to get them from a scalper later.
Right?
But chances are those scalp tickets are going to cost you a lot more.
Yeah, that's true. I see where you're going with this.
With post-tax plans, you're essentially locking in your tax rate. So if you anticipate being in a higher tax bracket in retirement, you're essentially paying those taxes now while your rate is potentially lower.
Ah, so you're getting ahead of those potential tax hikes down the line.
Exactly. It's like a strategic move to potentially reduce your overall tax burden over the long term.
That's a really interesting way to think about it. I like that. Okay, so let's talk specifics. We've got the Roth 401k and the Roth IRA. What are the key differences we should be aware of?
So the Roth 401k is similar to a traditional 401k in that it's offered through employers. You've got the same contribution limits. For 2024, it's $23,000 or $30,500 if you're 50 or older.
With the catch-up contribution. Got it.
Right. But the big difference is how those contributions are taxed. With the Roth 401k, you make contributions with after-tax dollars.
Meaning you've already paid taxes on that money.
Exactly. But here's the best part. When you retire and start taking distributions,
They're tax-free.
tax-free. As long as you meet certain requirements, those withdrawals are completely tax-free.
Okay, so that's a pretty sweet deal.
It can be. And there's another perk. No RMDs with a Roth 401k.
Wait, really? So I don't have to worry about those required minimum distributions during my lifetime.
That's right. That money can stay invested and continue to grow tax-free. You get more flexibility and control over your savings.
Okay, so let me break this down one more time to make sure I'm following. With a Roth 401k, I contribute after-tax dollars, meaning I pay taxes on that money up front. That money grows tax-free, and when I'm ready to use it in retirement, those withdrawals are tax-free as well. Did I get it?
You nailed it.
Okay, great. Now, what about the Roth IRA? How does that one differ?
So the Roth IRA has a lot in common with a Roth 401k after-tax contributions, tax-free withdrawals, no RMDs during your lifetime. But there are a couple of key differences to be aware of. Okay.
Lay on me.
First off, the contribution limits are lower. For 2024, it's $7,000 or $8,000 if you're 50 or older and eligible for that catch-up contribution.
Okay, significantly lower than the Roth 401k.
Right. And the other big difference is that there are income limits that might affect your eligibility to contribute to a Roth IRA.
Income limit. So you're saying if someone makes above a certain income, they might not be able to contribute to a Roth IRA at all.
Exactly. Those income limits change from time to time, so it's always a good idea to check the latest guidelines.
Got it. So this is where things can get a little bit tricky. That's why working with a financial advisor can be helpful, right?
Absolutely. They can help you navigate those complexities, figure out which plan aligns with your situation, and create a plan that maximizes those tax advantages.
That makes sense. It's not always as simple as just picking a plan and calling it a day. There's definitely a strategy involved.
Couldn't agree more.
So we've covered pre-tax plans, we talked about post-tax plans, but you mentioned there's one more thing we should touch on. You called it a wild card earlier, the HSA.
Right, the health savings account.
So most people, myself included, think of HSAs as being for healthcare costs. How does this tie into retirement planning?
Yeah, a lot of people don't realize this, but HSAs can actually be a really powerful tool for retirement.
Okay, I'm all ears. Tell me more.
So you've got the pre-tax contributions, which we've talked about with those other plans.
Right, so that's already a plus.
But then those contributions, they grow tax-free. And here's the kicker. You can withdraw that money tax-free for qualified medical expenses.
Whoa, okay, so it's like a triple whammy. Tax benefits up front, tax-free growth, and tax-free withdrawals for medical expenses. That's huge, especially since we know healthcare costs can be a major concern in retirement.
Exactly. And it gets even more interesting when you factor in what happens when you turn 65.
Okay, what happens at 65?
After 65, you can withdraw money from your HSA for any reason.
No.
It doesn't have to be for medical expenses anymore.
Seriously, yep.
Yep. And it's treated as ordinary income.
So it's like having this extra pot of money that I can tap into for anything once I hit 65.
Exactly. You can think of it as bridging the gap between retirement and Medicare, or even a safety net for any unexpected expenses that might pop up later in life.
That's a great way to look at it. It's like an extra layer of security, knowing that you've got those funds available if and when you need them.
That's the idea.
But I'm assuming it's not meant to be your primary source of retirement income, right?
Right. It's best to think of it as a complement to those other retirement savings strategies, not necessarily a replacement.
Got it. It's all about having those different pieces of the puzzle working together.
Exactly.
Wow, we covered a lot of ground in this deep dive. Pre-tax plans, post-tax plans, HSAs. There's a lot to think about.
There is. But the most important thing is to have a plan, any plan, rather than no plan at all.
I love that. A plan, even if it's a work in progress, is better than no plan at all.
Absolutely.
Well, I think that's a perfect place to wrap up our deep dive on retirement plans. Hopefully, everyone listening now feels a little bit more informed about their options and maybe even a little bit inspired to start planning or to revisit their existing plans.
And remember, retirement planning isn't just about crunching numbers. It's about designing a future that aligns with your values and aspirations.
Beautifully said. Thanks for joining us, everyone. And here's to a happy and well funded retirement.